Okay, so today we're going to be talking about recourse and non-recourse factoring. So you can see here definition of recourse factoring. Recourse factoring is when a company sells its account receivables to a factor, usually a financial institution, but retains the risk if the customer doesn't pay. How it works, the factor advances cash to the company. If the customer later fails to pay, the company must reimburse the factor or replace the unpaid invoices. See this as recourse liability. And accounting treatment, treated as a sale only if the receivables is transferred under GAAP. And we'll talk more in depth about this later. If not, it's treated as secured borrowing, which has different treatment. It stays on the balance sheet and is a liability and is recorded for the cash received. Any recourse obligation is recorded as a liability. Key takeaway here is that recourse factoring gives the company quick access to cash, but still bears the credit risk of a customer non-payment. And we'll see in the example of with factoring with recourse, the company selling their accounts receivable can sort of negotiate that finance charge to make it higher. So because they're taking on that risk for the factoring company um, within that recourse liability that you'll see. So what is non-recourse factoring? This isn't seen as often, but it's still a method that we need to go over. Non-recourse factoring is when a company sells its account receivable to a factor and the factor assumes all of the risk of any customer non-payment. They can't come running back to the company that they bought it from, say, hey, why didn't they pay? That doesn't work that way because they bought it without recourse. They're assuming that risk, and they should know that. How it works, the factor buys receivables outright and is responsible for collecting it from the customer. So if the customer does not pay, the factor absorbs the loss, not the company that they bought it from. The accounting treatment, it usually qualifies as a true sale under GAAP. Um, so the receivables are removed from the company's balance sheet. The company records cash received and any loss or factoring fee as an expense. No recourse liability is recorded since risk has been transferred. Key takeaway is that non-recourse factoring provides a greater risk protection for the company, but usually comes with a higher factoring fee because the factor takes on the credit risk. So we can go right into the examples here. Okay, so non-recourse factoring, problem one. Bryce Wayne Corporation factored out 163,900 of its accounts receivable with Julie Incorporated on a without recourse basis. Julie Incorporated charges a 2% finance charge of the amount of accounts receivable and retains an amount equal to 6% of accounts receivable for possible adjustments. Um, so you can see here that the finance charge is going to be a little bit lower than it would be if it was selling with recourse because Julie is accepting all of the risk here. They're not going to be able to negotiate a higher finance charge. So let's jump right into it. 163,900 is going to be your factored accounts receivable balance. Finance charge is going to be 2% of that. And then our adjustment to the factored AR that we're going to have on hand is that's 6%. So how we can calculate this is we know that the accounts receivable balance for Bryce Wayne is going to be that. The loss on sale of accounts receivable is going to be that finance charge. Um, the cash, we don't know yet, but we will. It's going to be this adjustment right here. This is going to be the receivable from Julie, from the factor. And then we can calculate the cash by simply taking this, subtracting the receivable as well as the loss on sale of accounts receivable to get our cash balance. And then the opposing entry for Julie Incorporated would be Julie is buying this accounts receivable balance here, right? We know the cash balance that we calculated. So that's how much cash they're paying. And then due to customer, it's going to be this right here. So this is what Julie is going to have to pay Bryce Wayne Corporation, as well as the interest revenue, which is going to be credited. And that is the loss on sale for Bryce Wayne is going to be the interest revenue for Julie. Moving on, for recourse factoring, Bryce Wayne Corporation factored $213,500 um, of accounts receivable with Julie Incorporated on a recourse basis after negotiation. So this is where you can negotiate that finance charge to be a little bit higher because you are assuming with recourse, a recourse liability in the events that whatever is in your accounts receivable, your customers didn't pay. So it's bumped up to 6% here. The amounts receivable retains an amount equal to 5% of the accounts receivable for possible adjustments. Julie Incorporated estimates the fair value of the recourse liability to be 8,290. So we'll do the same thing again. Take that 213, 500, calculate the finance charge here, which is going to be 6%. The for possible adjustments held on hand, it's going to be 5% of the factored AR. And then the recourse liability here, it's given to us in the problem, but sometimes it's not always that easy. It's going to be that. So loss on sale will be that finance charge, and this is where it gets kind of interesting. So the recourse liability, we're going to credit here, and then we're going to use the loss on sale and add the recourse liability to it to balance. And I have a little check set up here so you can check this. I just like to do this just to make sure everything on the debits and credit sides balance. So we can see here that you will receive this amount of cash today because we're receiving also this adjustment from the factor as well as we're losing the loss on sale right here. And then we are going to credit our accounts receivable balance for that factored out 213,500 as well as record a credit to recourse liability. All right, moving on here. Back to that, is it a sale or borrowing or secure borrowing? So straight from the textbook, for it to be a true transfer of receivables, it has to meet these three conditions here. A transferred asset isolated from the transferor. Number two, the transferee has the right to pledge or sell assets. Number two, and number three here, transfer does not maintain control through a purchase agreement. If yes, is there continuing involvement? Yes. Record as sale? No. As yes, record as sale, reduce receivables, recognize assets obtained and liabilities incurred, record gain or loss, which we did earlier. Is there not continuing involvement? Still, we're going to record as sale, but we're going to reduce receivables and record gain or loss. And if these conditions are not met, we're going to record as secured borrowing, record these liabilities, and record the interest expense on the balance sheet. Um, so is it a sale or borrowing? If criteria is met, you don't need to record in most cases. If it is secured borrowing, on the other hand, we're going to have to record these on the financial statements to comply with GAAP. So this would be a little example here of if conditions were not met, we're going to debit cash, we're going to debit receivable from factor, that adjustment, and then we're going to credit the notes payable. Um, General rules for presenting receivables and financial statements. So number one, separate the different types of receivables that a company possesses, if material. Appropriately offset the valuations of accounts against the proper receivable accounts. Number three, determine the receivables classified in the current assets section, converted into cash within the year of the operating cycle, whichever is longer. And then we're going to have to disclose any loss and contingencies that exist on receivables, disclose any receivables designated or pledged as collateral, and then disclose the nature of credit risk inherent in receivables, how the risk is analyzed, um, assessed as arriving, allowance for credit losses, and changes of reasons for those changes in allowance. It's a lot to take in, but we're going to show a little example here of how Coca-Cola recognizes their trade accounts receivables, which basically goes over how they've determined how they're recognizing their trade accounts receivable because it's in a note of the financial statements. It's not actually on their balance sheet. So we're going to open this up here. Alrighty, so here is the real world example from Coca-Cola. So this is their trade accounts receivable balance. And it's kind of cool to read through. It's basically all those rules that I just mentioned, you can kind of see on display here. So we record trade accounts receivable and net realizable value. This value includes an appropriate allowance for estimated uncollectible accounts to reflect any expected loss on the trade accounts receivable balances and charge the revisions for doubtful accounts. And it goes into how they calculated this, which is very similar to our example here. And then, which is really cool, is we get to actually see how much of the account receivable they actually factored out or sold within the year. So within the past 2 years, 2023 and 2024, the company sold 21.873 million and 17.704 million of trade accounts receivable under their trade accounts receivable program. So, they're factoring out more and more accounts receivable every year. And then you can also see the true costs of this. So these would be those adjustments um, that we would withhold that we went over in the examples. And these are the costs of factoring. In 2024, it was 114 million. And in 2023, it was 83 million respectively. It also tells you how the company accounts for this program. So um, the company accounts for this program as a sale, and accordingly, the trade accounts receivable sold are excluded from the line item trade accounts receivable in our consolidated balance sheet. So this just means that those rules that I went over, yes, it did qualify as a sale. They do not have to record it directly on the consolidated balance sheet. And no, it is not secured borrowing, obviously, because it's taken out. And instead, the cash received from the financial institutions is classified within the operating activities section in our consolidated statement of cash flows. So that's kind of cool. It also shows up there if you wanted to check that out. Um, and yeah, that's basically it. Thank you.